Thanks for joining us close to Christmas and probably a good time for a November look through. So as usual, we've got John here to talk about markets and the economy, and I'm here to talk about how that fits through into the portfolio. So to kick us off, John, why don't you talk about what happened in November?
November was a good month for markets. Equities returned some pretty good gains of around 3 to 4%. Bonds also did well because we had a US Federal Reserve rate cut. And the US corporate earnings season, again, was quite a big tailwind, I think, for the equity markets. So in the round, multi-asset portfolios would have performed pretty strongly in the month of November.
Yeah, and I think that's kind of what we saw with the CSI fund. So, the income fund was up kind of roughly 2% over the month, and the growth fund up kind of 3.4%. So pretty strong returns, really, pretty strong absolute returns over the month. And as you kind of alluded to, I guess US was quite a big driver. So you kind of touched on it there, but obviously, do you want to try and give a little bit more detail about kind of what happened in the US and what happened with the US markets, I guess?
Yeah, I think there's been a sense in which the markets still pursue this idea of US exceptionalism. You know, US economic growth has been very strong this year. Federal Reserve has been pretty aggressive in terms of rate cuts, and that's continuing to come through. Liquidity cycle's been positive, and as I say, the backdrop of corporate earnings and then expectations around strongly reflationary policy from Donald Trump next year, all of those have really continued to drive a big inflow of portfolio flows into the US equities, and they've outperformed. Now, the extent to which you've had a small underweight has been a bit negative for us, but I think, you know, there's plenty of evidence now that equity market performance is broadening out around the world, and we expect to see more broad-based corporate earnings delivery as we go through next year as well. I think that will also prove to be a tailwind for a more active approach in terms of asset allocation than the sort of more dominant passive approach that we've seen this year.
I think we've kind of seen that. You know, we've had areas of the portfolio where we've had really quite good returns, I think, particularly on a kind of an active basis. And if I think about that, things like our UK stock selection has been a really positive driver. You know, we do hold some kind of active, kind of slightly off benchmark positions, the likes of Sage, you know, the UK software accounting company, Games Workshop, the kind of tabletop miniatures, which is now in the FTSE 100, you know, Burberry, the kind of, you know, globally known UK fashion business. You know, these businesses have all returned kind of more than 30% over the last 3 months. So some really strong performances. But I think, as well, when we think about our UK allocations, you know, we clearly need to not forget about some of the kind of core companies that make up the kind of ballast of that UK portfolio. You know, the likes of Diageo, the likes of GlaxoSmithKline, the likes of AstraZeneca, the likes of Experian, the likes of Rio Tinto. You know, these are big companies that I think really provide a good core to some of that, you know, active stock picking in the UK. So, you know, I think maybe just whilst we're on that, you know, what are kind of your thoughts on the UK market and where, not only from the kind of stock market, but also maybe from the UK, you know, economy perspective and how we're kind of sat there?
Yeah, I think we're going to get a fairly reflationary picture for the next 18 months in the UK. You know, high nominal GDP, because the budget itself that we had recently is going to be stimulating economic activity in a front-loaded fashion. That will probably align with some better sales growth. And some of the companies that we hold also are aligned cyclically to a better outlook for Asia and China, and of course in China we've had some fairly aggressive policy stimulus over the last 6 to 8 weeks, and I think that will also prove to be a tailwind for some of our stock selection.
Yeah, I think we might see some of the kind of luxury companies that have really suffered recently, you know, have a bit more of a positive backdrop. So, you know, there I think of the likes of LVMH, I think of the likes of Kering, which own Gucci, I think of the likes of Burberry, and I think there might be opportunities there, which you know, hopefully will be really positive. But I think generally you're talking about quite a positive equity story, which I think, you know, is you know, a quite good backdrop. But I think we need to remember that's not the only part of the multi-asset portfolio. You know, we've clearly got to think about bonds as well there. So it'd be interesting to kind of get a bit of a take on where you think bonds are at the moment and your thoughts on that.
Yeah, I think for bonds, short and intermediate dated maturities will tip the coupon next year, so we'll probably get the kind of return that the yield implies. There's a little bit of a concern about longer dated bonds. You know, the UK budget, I think, was taken a little bit negatively in terms of debt sustainability. I'm relatively relaxed on that front, but I think in the US, with Trump in charge and the prospects for fairly aggressive tax cuts, that could certainly boost the debt to GDP ratio significantly higher over the next 10 years, and I think markets are going to worry about a looming fiscal cliff there. So I think, you know, until that gets resolved or yields go to a higher level, we'd be a little bit cautious on long-dated bonds. But they are good ballast against weak data, so if the economy does hit the skids next year, we'd expect bonds to perform pretty well.
And I think that's how we're positioned, within the CSI funds. So, we're pretty happy to lend. In fact, we're very happy to lend money out, as to essentially be buying kind of fixed income. But we would prefer to do this over a shorter time frame.
Yeah, but as yields rise, if they were to a reasonable degree, I think we would be increasing our weights there.
Yeah.
And if there is a hard landing, clearly bonds will do well. But we are of the view that the economy will do pretty well next year, and therefore, bonds are a diversifier rather than a source of return.
That actually leads me quite perfectly onto a forward-looking view. I guess we're kind of coming up to Christmas, so 2025 around the corner. So on an outlook basis, where do we kind of think the world's headed?
We think we're going to see moderate growth next year. We'll see better growth in Japan than we saw this year. Slightly weaker growth in the US than we saw this year. The US has done really well. China probably gets a boost from some cyclical stimulus that we're seeing. That may not prove to be long-lived, but it will still be in evidence. Europe, I think, will see a bit of benefit from rate cuts, and the UK will go quite well because we've had a fairly reflationary budget. In the round, I think a multi-asset portfolio should generate returns consistent with the long-term average. If we're wrong and there's some upside risk, we could see returns somewhat higher, and that would be with growth being more resilient around the world and a bit more aggression in terms of central bank cuts. And if we're wrong on the downside, we get a hard landing, we see a 1 in 5 chance of a recession, that would give us negative returns, but clearly bonds would be a beneficiary of that and provide good ballast in a multi-asset portfolio.
I think that outlook provides a kind of great platform for us to then build multi-asset portfolios around that. We clearly have to think about the opportunities for that kind of strong performance, but also the risk that actually we may have a challenging market, and I think that's what we're thinking about as we build those multi-asset portfolios to hopefully deliver kind of great outcomes in all kind of scenarios. Yeah,
and I think there will be a considerably broader array of potential sources of excess return next year than this year. I think that's why we're quite excited about the year ahead.
And on that happy note, I guess a Merry Christmas.
Thank you.